Hello. Today I'm joined by Edmund Harriss, Fund Manager of the Guinness Asian Equity Income Fund. The fund invests in high quality, dividend paying companies based in the Asia Pacific region. Edmund, could you firstly run through how many companies are in your investable universe, and then how you narrow down that choice to hold less than 40 companies in the fund?
Sure. To start at the top, there are about 8,000 companies listed in the Asia Pacific region. And what we are looking for are companies that have exhibited, demonstrated, and delivered upon a sustainable competitive advantage. And we identify these types of companies as those that have sustained a return on capital, so a higher level of profitability than their cost of capital, and sustained it year after year after year in consecutive time periods. And companies like this are the types of companies that we think have these kinds of competitive advantages that are delivered and translate into cash-based profitability sustained over time. So we screen the 8,000 companies in the Asia Pacific region. We use a metric, cash flow return on investment, which is a Credit Suisse Holt metric, for a return on capital that has been at least 8% for 8 consecutive years. It's quite a high threshold. We add another criteria. We don't want anything that's too highly geared, so we want moderate debt levels, so debt to equity no greater than 1. And that brings us down to an investable universe of around 560 companies. So that's our hunting ground. We're looking for these types of companies whose returns on capital have been above the cost of capital and we think are likely to persist. And then we are selecting from that group.
You touched on it in your first answer, but could you go into a bit more detail regarding how you assess whether a company can sustainably grow its dividend in the future?
Yeah, the type of companies we're looking at that are sustaining or have sustained high levels of return on capital above their cost of capital, these are sort of wealth creating companies. And the types of business we're after are those that have been able to deliver superior profitability and are therefore likely to continue to do so. They're reinvesting in their business, but are generating more cash than they need for reinvestment. And that is the source of the dividend. So in effect, what we are saying is to find companies with sustainable dividend growth, you need to look at the engine, the operating assets that generate the cash in the first place. How much cash is the company generating? How much do they need to reinvest? And is this excess cash coming out as a dividend a part of that disciplined capital allocation decision? But in short, as companies reinvest in their business, generating these superior returns, their profitability should grow and the dividend should grow along with it.
Across developed markets, a dividend drought played out in 2020 as businesses cut, cancelled, or suspended their dividends in response to the pandemic. How did companies in the Asia Pacific region respond?
Yeah, it's a good question. It's quite variable. If you look at the Asian region as a whole and say, look at what happened to dividends, say use a benchmark as your criteria, then dividends in Asia fell by about 20% last year. But the experience within the region and within sectors was pretty different. So, for example, in somewhere like Australia, dividends fell by over 40%, New Zealand by almost 30%. But if you look in areas of Northern Asia, like China and Hong Kong and Taiwan, you saw dividend declines of a single digit, sort of 7, 8, 9%. And in Korea's case, on an index basis, even managed to grow theirs. So you have to then sort of look a little bit under the hood and say, well, those markets that are dominated by banks and materials companies, so that would be Australia as a for instance, you saw much more profound dividend cuts. Those that were more on the technology end and so benefited from, say, at a very simplistic level, the sort of the work from home phenomenon, the growth in data centers and handheld consumer devices, etc., those companies saw their businesses pretty much unaffected. And so therefore they were able to sustain their dividends rather better.
So how many of your holdings cut their dividends in response to COVID-19?
Well, just before we sort of give the numbers on that, it's just worth pointing out that in Asia, you've got two types of dividend policy prevailing in the region. You have those that operate a progressive dividend, so are looking to grow their dividend by increments every year. And so therefore that runs independently. And if there's a dividend cut to that, that is a sign of severe business stress. But the majority of companies in Asia tend to operate a payout ratio. So they distribute a proportion of their earnings. Their policy is to distribute 30, 40, 50% of net profit. And therefore those dividends will tend to fluctuate as profitability fluctuates year to year. But to answer your question absolutely directly, we have had 21 companies increase their dividend, 2 were flat, 7 were down, and 1 omitted its dividend. So by and large, we did okay, but I would say 4 companies in total had to respond to COVID in one way or another. Those that cut their dividends because, say, they were banks, and for prudential reasons, the monetary authority in whichever region wanted banks to scale back their dividends. We had a couple of instances of that. We also had a company in the travel sector in Australia whose business pretty much dried up. The business itself is scalable. They had cash on hand, but there was no business. And so therefore a dividend in that context would make no sense. And so therefore that was omitted. But by and large, okay. And the fund saw its dividend in 2020 decline by about 14% in sterling terms. And what we're looking forward to now is how dividends play out, because obviously dividends are a lagged effect. The dividends that are coming out now follow the COVID period, but are a mix of difficult trading conditions in the past, but maybe a more optimistic outlook.
Edmund, thank you very much for your time today.
Great, thank you.